Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. I mean, today's tape basically unchanged. It kind of feels kind of like where we are overall in these markets here. Feels range bound, as we've heard from some guests kind of suggest. And the question is, kind of what moves you out of that range? Maybe our next guest has some thoughts here. Joe Mazzola, he's over at Schwab. He is the managing director, trading education at Charles Schwab. Joe, you're at Schwab. You guys see everybody. You see everything out there because you have so many clients out there. What do you feel like investors are kind of the biggest issue for investors right here?
I think there's probably three things that investors are really kind of keying on right now. Interest rates being number one. You guys just kind of led into that. Back around 4.5%, 4.55 in the 10-year. I don't think it's the move itself. It's the magnitude and how quickly it moved. I think that's shaken markets up quite a bit. I think the second thing is the political landscape, and there is more risk around a government shutdown. I think maybe we sit back and say, well, this will work itself out, but there's real risk that this could carry on for a while and could have some economic impacts. I think the last thing, and probably maybe front and center in investors' minds, is inflation data. It did seem like it was subdued over the summer. It seemed like people were kind of able to kind of get ahead of it and see the end in sight. But we started to see it kind of tick back up. We get PCE data on Friday, so it'll give us a little bit more of an indication on where we're at. But that's absolutely front and center for our investors' minds.
Abigail Doolittle looked at the technical analysis, and she thinks we could float down below 4,200 on the S&P 500. I guess I would imagine that retail investors look at these yields and find them attractive, especially versus stocks right now. How are your clients trading it?
So we look at a couple things, right? We look at the S&P earnings yield versus the 10-year yield, and you look at that spread, and we're back at levels that we really haven't seen since prior to the great financial crisis. Meaning, look, that whole TINA talk that we've had for 15 years, that's out the window. There is an alternative. There's an alternative in fixed income. There's an alternative in money markets. A lot of investors are comfortable just kind of sitting in 5% yields and waiting for the market to work itself out. I agree 100% at looking at some of these technical levels right now. It does seem like, we've moved into a bit of a lower range. And the reason I say that is because we broke that 43.50 range. I think we have some room to potentially go maybe down to about 42.10, where you might see a bit of a bounce. That's kind of that intersection of where the 200-day moving average is sitting right around 4,200. But you also have a Fibonacci retracement level from the one-year highs right around that level as well too. But a couple of things that I've been paying attention to, and a lot of our traders and investors have been talking to us about, is this idea of the market breadth and how it's really weakening. We're just not seeing a bounce, and we're not seeing it across the whole spectrum. If anything, really the only sector that's held up well is energy, with about 90% of its components in the S&P 500 up above its 50-day moving average. But when you look at the S&P 500 as a whole, we're around 25% of the S&P 500 up above its 50-day moving average. And that's just not, it's not at a level that supports a bounce. Now, what I'd like to see is a little bit more of a washout. I'd like to see us get down maybe around that 10 or 12% level to see if we get a bounce from there. At that point, maybe some of that bullishness kind of fades from the market. You might start to see some that washout occur where buyers might start to step back in.
Hey, Joe, when you talk to the Schwab customers, what are some of the sectors that they like right here? If you just kind of look back at this year to date, if you owned, the Magnificent Seven, boy, this has been a great year. What are they most bullish on at this point, or maybe what are they most concerned about?
Yeah, Schwab customers for sure are looking at really two sectors right now: energy, and they've done well in that over the last couple months. I think if you look at a sector as a whole over the last month, it's up over double digits. And then information technology, so IT. So they continue to be buyers there. They're looking for opportunities on sell-offs to kind of step in and buy at those levels. But those are the two right now that they're really looking at. The ones that they are really shying away from are real estate and utilities. Those are the ones that they're very bearish on right now.
In terms of real estate, is it a problem, with these higher rates, with higher mortgages, with refinancings coming due? I mean, both on the retail and, residential and on the commercial side, there are some big question marks there.
No, I think you hit the nail on the head. I think when you're starting to look at a 30-year fixed mortgage up above 7%, 7.1, 7.15% at this point right now. I mean, just look at what we've seen in existing homes. I think 90% of the U.S. has a mortgage under 5%. What's the impetus to move to a new home? I think they're kind of sitting still, and that's cut down on supply, which to a certain extent has held housing prices in check. It hasn't. We haven't really seen a big decrease in housing prices. But at the same time, it's just not really providing the catalyst for people to move. Not until you start to see a real break there. I know there is some pent-up demand, and supply is starting to hit. We've seen that on the new home sales exceeding existing home sales, and we've seen that spread continue now for basically a year. But until you start to see those mortgage rates kind of tick back down, I don't think you're going to see a lot of buying momentum there.
So, Joe, the good folks at Schwab, is it your base case that we're going to have a recession? And if so, when? Or do you think we can skate past one?
Well, I can tell you what our investors and what our traders are telling us. About 69% of them do believe that a recession is coming. But they do believe that it'll last less than a year, and it might not be as deep as maybe some are predicting. I think that the belief is that it'll happen in 2024, and they're constantly looking at this battle between the soft landing a scenario and a recession, and I think they're probably skewing a little bit more towards recession side at this point.
So, do people back up into these rates? Do you buy, treasuries and even maybe go long a little bit of duration if you're worried about a recession?
Well, I'm not a fixed income guy, but I can tell you, what our traders are telling us, and they have been bearish on. Let me rephrase it. They've been a little bit more bearish on bonds than they were in Q2. So in the Q3 survey, they pulled back some of that excitement towards bonds. But I think that what we're starting to see now is maybe a little bit movement back into that sector. And we're starting to see it, of course, on the money market side as well, too, as people are kind of waiting for a correction in the market. I think the thing that's frustrating for investors right now is it's kind of a slow grind down, right? I mean, we're not really seeing a big pop in the VIX. We're still below 20. We haven't really seen a big pop in the MOVE index on the fixed income side, which is showing that, investors and traders, they're not comfortable at this level, but at the same time, they're not panicking either. That's why I talk about that washout. Until we see that washout, I think we just can continue to see this grind down within this lower range.
Hey, Joe, thanks so much for joining us. Really appreciate it. Joe Mazzola, he's a managing director and trading education at Charles Schwab.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Jackie Bowie joins us. She's a managing partner and head of EMEA at Chatham Financial. Jackie, investors here and folks here in the States, we kind of feel like our economy's okay. Inflation, we like inflation to come down a little bit more. Higher rates are hurting, particularly if you want to go out and buy a house. But generally, things are okay here. People feel like, I think generally things are kind of in the right direction. But Europe, not so much. Talk to us about kind of the economic backdrop that European investors and investors that invest in EMEA over in Europe and emerging markets, what are they dealing with?
Well, I guess the trends are very similar around, higher inflation, higher interest rates, and a concern that those interest rates are starting to impact the real economy. I think the differences in Europe and in the UK is that getting inflation under control has not been quite as successful, you could say, as the Fed have managed to do. And there's also a huge divergence within the economies. So we think about the EU as one geographic zone. But in fact, if you look at the economic performance of Germany, for example, in recession, very industrial economy, not doing well, versus like Spain and Ireland, who are showing decent growth. So it's hard to make a uniform statement across the board, and certainly a lot of divergence between the individual country performance.
How difficult are higher commodity prices? Last year we were really worried about Germany and continental Europe. As gas prices rose up, they managed to avoid taking a huge hit from that by storing enough. But is it still a concern?
Definitely. And I think it's a real concern right down to the consumer level in terms of perception, because as soon as the headlines start to come through, particularly about the oil price, everyone realizes how much that really impacts what they pay both for energy and also the cost of fuel at the pump here in Europe, in the UK, which is much higher than it is in the US. So I think there's a bit of a concern that if consumers start to see that, they will then start to rein in spending as they prepare for perhaps another winter of significantly higher energy costs.
In Germany, I mean, I guess there's such a importance of China as a trading partner, and the China reopening has been disappointing relative to, I guess, maybe the beginning of the year expectations. How is Germany and its economy dealing with that?
Well, if you look at the headline numbers of the GDP levels, you could say not very well.
Yeah.
As you implied, Germany is obviously a big export economy and pretty much reliant on a lot of those overseas markets, China just being just one of them. And if we think what happened through the pandemic, where we had supply chain issues, which was then impacting growth. And now we have it on the demand side. So we've gone through a full cycle with none of the upside of the upcycle because you've had a bit of a double whammy on either side of that. I mean, there are other things that are specific to the German economy, a whole other topics around the green agenda and the cost for businesses to try and comply with what Germany are trying to do around sort of green and sustainable policies, which is definitely impacting the economy as well.
Is the green transition not going to be a driver of growth down the road? I mean, I look at expectations for the German economy, and they're low, obviously. We're looking for a contraction this year and only 0.6% GDP growth next year. But is the green transition going to be a driver there, or is Germany going to be penalized by its reliance on the internal combustion engine industry?
Yeah, I think if we were to look 10 years ahead and then look retrospectively, you might be able to say that the transition to green overall created jobs, created growth. I think the pain comes in the transition period. If you look at the number of people who are still employed in industries around fossil fuels, around the automotive industry, as in fuel-powered cars, not electric cars, it's huge. And you don't just get an automatic replacement of them; you get a displacement which impacts the economy before, call it, the new green economy starts to take off. And I think there are more concerns that the short-term pain of pushing towards sustainable policies. The same in the UK, and our Prime Minister's now starting to rein that in a little because he realises that the transition period will be painful.
By the way, how's Brexit been?
Boo.
2016, right? Was that 2016?
I can't believe that.
So 7 years on, are you just reveling in the benefits of independence? I mean, has it been just an amazing weight lifted from your shoulders, the freedom of doing it on your own, all the incredible trade deals that you've made? I mean, what courage, that took.
Yeah, so I think the idea of Brexit had lots of very positive components. The challenge for the UK government was in the execution plan, and circling through 4 prime ministers in that time to try and execute the plan in the middle of a global pandemic meant that getting those big trade deals done was definitely more of a challenge. And of course,
too much partying, right? They shouldn't have partied so much.
Got to let their hair down. And I think the issue now, just coming into the political cycle, I know it's the same in the US as we come into 2024, that we're starting to see, really big shifts in the sort of left to right movement, or whatever way you want to look at it, in the direction of travel, where, in the UK, the leading party in the polls is making very clear signs about a much closer relationship with the EU again. So just as businesses have got used to the new operating environment, you start to sort of inject more of that uncertainty back in. So we'll see how the politics shape up next year.
Jackie, thanks so much for joining us. I really appreciate it, getting your views. Jackie Bowie, Managing Partner and Head of EMEA at Chatham Financial, based in London.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Former colleague of ours, Callie Cox, back in the studio, U.S. investment analyst with eToro. So, Callie, what do you make of this market? I mean, there's people last 4 or 5 weeks, people have gotten very nervous here about this whole interest rate environment and what it may mean, how do risk assets perform in a higher for longer environment, but does that really bring back onto the table recession? How do you guys think about that right here?
Yeah, well, we see people building a wall of worry, and we think that's a good thing. And I'm not trying to be overly optimistic here, but if you think about this list of worries that we're going through, student loan payments restarting, if you think about higher oil, higher yields, potential government shutdown, there's a reason why people are nervous, but put them all together, and I could only count a few of those as actual systemic risks to the economy. So that's what we're telling customers. Keep an eye on oil, keep an eye on yields, even though yields are telling us a good thing, still pressure on the economy and markets, but everything else might just be a distraction.
All right, so I'm sorry, but you sound still pretty constructive on these markets here?
We're I hate this phrase, but cautiously optimistic.
Okay.
We're constructive, but we're also asking people to really tread carefully and pick up quality risk. Don't go all out here. I mean, we are in a bull market until proven otherwise, until we see that recession or that crisis. Right now, there are a few signs of that, but at the same time, we don't know what cracks could be forming underneath the surface.
So how worried are you about the government shutdown, which is very likely to come this weekend, the strikes, the UAW strikes being prolonged? I mean, is this a factor in your analysis?
Yeah, so we think about the strikes and the shutdown a bit differently, even though the shutdown is kind of like a forced strike from government employees, right? So the UAW strike, of course, is front and center of our minds, especially because we have a lot of investors who own auto stocks. And this is a big deal for the auto industry. I mean, luckily, we're talking about U.S. production here, and U.S. production is just a small share of global car production. I mean, U.S. consumers use a lot of cars, but they don't exactly produce a lot of them. So we think global production could fill the gap there, but at the same time, I mean, this is another worry to lop on top of an economy that's under a lot of pressure. Government shutdown, again, I mean, if you look historically, they haven't made much of a dent in either the economy or markets. It's usually just a distraction, but going back to systemic risk, I mean, we don't know what's happening underneath the surface, and we're encouraging people to not freak out too much, but understand that this is just another piece of pressure that investors have to think about.
Well, why don't I just sit with my 2-year Treasury at 5.1%? That's pretty good.
I mean, a lot of people are doing that. I mean,
so is that something you guys? I mean, is that something you guys are seeing from your clients or hearing from your clients, and what are you telling them about that?
Oh yeah, we hear it all the time. We did a webinar with clients yesterday, and that was one of the first questions that came up, and it's a very fair question. I mean, that's the 5% is the most you've been able to get on money in 30 years. So we frame it like this. I mean, time frames matter a lot when it comes to considering whether to go into cash or go into equities, or basically when you're determining how much risk you're taking on here. Because cash at 5% is great for short-term goals, but remember that yields are probably not going to go much higher from here. The economy is probably going to slow down from this 5% annualized pace people think we're growing at in the third quarter. And if that's the case, if the Fed starts cutting rates into next year, that's the rate that you're getting paid on your cash and, on your bonds, unless you, of course, hold them to maturity. So, we have a lot of longer term investors on the platform.
Well, if you get 5%, on a 20-year, you're getting that for the next 2 decades, plus the appreciation. If yields go down, your capital is then worth more.
Yeah, and it's tempting, but you also have to remember the S&P has a 7% average annual return, and that compounds as well over the years. So, with younger investors, with a lot of millennials and Gen Zs on the platform, we tell them to think about the fact that they have time on their side. So cash is good, but you really have to think in the gray areas when it comes to portfolios. Who is
a typical eToro client, customer?
So we skew toward the older millennials and the Gen X's. But we do have a younger investor base when compared to other traditional platforms.
Did they invest differently? Did they think differently, or is it just simply hey, you guys are young, you need to think longer term, and over the long term, stocks outperform most other asset classes? Is that kind of the basic message?
Well, they're a little more complicated than that.
Okay.
A lot of our customers are those long-term investors, but they have that active account on the side. They're interested in crypto. They're interested in investing with the community.
Because we never talk about crypto anymore. It seems like it was almost every day, and I used to quote it all the time, but now we don't talk about it.
Why bother? It's just 26,000 without looking. Let me see. I haven't looked today, but
you're probably pretty close.
And I mean,
26.
I think it's more interesting to talk about investing with the community. So what exactly does that mean? Somebody has a model portfolio, you might like it, and you can then clone that portfolio, like tracking an index.
Yes, so we offer that for crypto, Matt. We call that not our smart portfolios, but being able to follow somebody and being able to invest if you like the crypto that they're investing in. I mean, that's what we're trying to promote here. We're trying to promote the transition of ideas, the ability to talk about what you're investing in, and the ability to see what other people are investing in as a track record type thing. These are my returns. This is what I have in my portfolio. If you see yourself as a similar investor, then maybe you
But is it only for crypto? I mean, can I not, like, if Paul goes on there, can he put his munis and all of that sort of baby boomer stuff on there, and I can say I want a boomer account, so I just clone his account and do the same thing?
Not in the U.S. yet, but we're hopefully working toward that. And Paul, if we get there, I would love to create a baby boomer portfolio just for you.
There we go. See,
he's the tail end. He's the last. He's the last month of baby boomers.
Still counts.
Literally, December 63. John Tucker, he's more firmly ensconced within the.
Callie, you're closer. Would you reach over and just smack him?
All right, so
I don't know if I can do that.
Callie, what's kind of the big issues that are coming up from your clients? You had the webinar. What are they worried about? What are they excited about? Your clients.
Yeah, well, they're worried about a recession, but the funny thing is they feel really good about their financial situations right now. They say, I don't have a reason to really change up my portfolio, but I'm frozen. I'm not quite sure what to do here, especially because things just don't feel good around me. So we're encouraging them to, again, focus on their whys, understand what their different accounts are for. If they want to be active, there are plenty of opportunities in this environment. You just have to be careful. And on the long-term side, I mean, we're quite optimistic on the U.S. economy over 10, 20 years. Everybody is. But, when you look over the next year, you might have some chances to, jump back into a stronger market.
Are ETFs, do you guys even recommend mutual funds or talk about mutual funds, or is it just ETFs now?
So we have ETFs on our platform, and we're actually noticing that ETFs as a share of volume is growing. Investors are looking toward diversifying their portfolios, or looking toward broader market and sector trends. So that's a trend that we're watching closely. I feel like everybody is, but it's something that the average investor is picking up on.
I can't even imagine the future of the mutual fund business. I mean, unless it's in a retirement account, why wouldn't you just ordinarily?
Well, but we haven't seen the continuation, not at last year's pace, of conversions to ETFs.
Right.
Which I don't know why that slowed down. In fact, that's a really good
conversion
question.
of a mutual fund into an ETF.
Yeah, last year that was huge, right? And the beginning of this year as well. It's kind of slowed down a bit, but I can't imagine why you would want a mutual fund rather than an ETF, other than, you're not allowed to have ETFs in certain investment cases, so you have to use mutual funds for that.
Yeah, that's the only case I can think of too. I mean, as an investor myself, I have no reason to use mutual funds.
All right, Matt. Yesterday was the beginning of basketball preseason practice. So my question to Callie, being a proud alum of that trade school in Chapel Hill, North Carolina.
Without knowing it, I knew it. She's a Tar Heel.
It's always basketball season when you're talking to a Duke fan.
Yes.
Right.
So what's the outlook for Chapel Hill this year?
Oh, man. Well, we've had a lot of turnover on our roster. We have Baycott. He's a big guy. He's really good. But quite honestly, the turnover we've seen, I think it's going to be really hard to tell.
Historically in these conversations, though, Callie, don't you say, hey, guess what? Jordan didn't play at Duke, right?
I mean, that's the thing we can hang over your head forever, right?
What we always say, the only person that can guard or keep Michael Jordan down is Dean Smith, the coach. He's the only one that could keep Jordan from doing amazing things, Dean Smith, by limiting, the type of playing that he could do.
But Jordan did amazing things. He's the greatest of all time.
Of all time, and he got that in the pros. But anyway, so It'll be interesting because what's the feeling about your coach, Hubert?
I love Hubert.
Now,
he's part of the family.
Now, but does that still hold within the alumni base? And is he still really well supported?
I think so. He's on thinner ice than he was, of course, last year. And he's done a really good job recruiting, but it's putting different pieces together on a team that's not used to playing like the three ball, basically.
Yep.
We're very big into getting into the middle and, grinding in on right below the basket.
All right, now Chapel Hill also has a good football team this year.
We do. I would love to talk about football here because apparently Duke is good.
Very good. Now
that doesn't happen a lot.
It doesn't happen almost any time. They beat Clemson this year at Duke. The last time they beat Clemson was when I was a first-year business school student in 1989. Beat Clemson. I was at that game. It was pouring rain. I was the only one from my study section because we had a big exam on that Monday. Everybody else was doing the smart thing and studying for the exam. I was out in the pouring rain watching Duke beat Clemson, John. So that's kind of how I put my priorities in business. It was a long road to dig out of that hole I started myself in, but
But it was worth it.
Yeah, exactly. I passed. It's all good.
It's a historic moment.
It is. So it's all good. Callie Cox, thanks so much for joining us. Callie Cox, U.S. investment analyst for eToro and a proud graduate of the University of North Carolina.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Bankrate.com, 30-year U.S. Fixed rate mortgage, 7.78%. I'm not going to complain about my 6% mortgage anymore. Ouch. And you've got the 3 something.
Yeah, well, 3.25.
Yeah, there you go. Yeah. So, I mean, how can I know if you look back like a gajillion years, that's pretty much in line with the average, but still, that hurts. But let's talk to somebody who does this stuff every day. Odeta Kushi, Deputy Chief Economist at First American. Odeta, what's your 30,000-foot view of this residential real estate market? I mean, nobody wants to get out of their house. Nobody wants to sell. If I want to buy, I got to pay this huge mortgage. It's kind of tough out there, isn't it?
It is very tough out there, a lot of headwinds in the housing market, but it's resulted in some really interesting dynamics. The first of which is that we're seeing a reacceleration in house price growth. You've got demand still surpassing supply, and that's Econ 101, right, for house price growth. And so we saw the S&P Case-Shiller reaccelerate. We've seen it up on a year-over-year basis after declining for 3 months in a row. So, and that's pretty broad-based across most markets, of course, with some regional differences. And the other dynamic here is because there are so few existing homes on the market, because of that rate lock-in effect that you alluded to, people are going to the new home market because builders are offering incentives, they're buying down rates. And so the new home market has actually fared better than the existing home market this year.
So what does that mean for affordability? I mean, prices are up, rates are up. Is this a market that is just, deadly for first-time buyers?
It's really tough out there for first-time buyers. As you mentioned, affordability is a function of home prices, interest rates, and incomes. And home prices are up again. Interest rates are moving higher. Incomes are increasing, but it's not enough to offset the impact of higher rates and prices. So it's tough out there as a first-time home buyer, but we are seeing them look to the new home market because, again, with rates at 7%, builders are buying down rates to 6%, sometimes even 5%, and oftentimes also cutting prices on homes. And so the new home market is actually more affordable than the existing home market, which is not traditionally the case.
How are builders able to do that? I've been hearing this too, and I find it fascinating. And how long will they be able to keep that up?
I think it'll be tough. I mean, we saw the new home sales number come down in August, rates at 7%, over 7%, really biting into affordability and cutting down demand. And, builders have had the margins to be able to buy down the rates, but the higher that mortgage rates go, the more difficult that will be.
Odeta, I'm just, again, on that bank rate, 30-year mortgage, 7.7%. That's the highest since 2000. Just extraordinary. So I guess the question is there a rate out there that you think is a clearing rate, for lack of a better word, where it might kind of loosen things up and buyers will be willing to take that mortgage? Sellers
what will bring
willing?
About the great reset, as a lot of people have called it, the expected event?
Well, more than 90% of existing homeowners are locked into rates below 6%. So I think certainly if we could start approaching 6%, we'll start to see a lot of activity. There's a lot of buyers on the sidelines. There's a whole generation of millennials that are out there looking for that first home and, on the sidelines waiting for that mortgage math to work for them. So I think if we can start to get rates heading lower, approaching that 6%, certainly that would bring some folks off the sidelines.
What about adjustable rate mortgages? How popular have they become?
We start to see adjustable rate mortgages, the use of those increase as rates increase. So we've seen them come up a little bit over the last year as mortgage rates have increased, but they're still a smaller share of the market.
If I want to go get a mortgage, can I even get one here? And how is the mortgage origination market?
Mortgage standards have been tight, right? So not even just this year, but generally speaking, and certainly compared to the early and mid 2000s, lending standards have been significantly tighter, and so it's probably tougher out there to get a mortgage. Certainly tougher to get a jumbo mortgage if that's what you're in the market for, and so that's sort of another headwind to the housing market.
What's the regional factor here? I mean, it just seems like we just heard so many stories during the pandemic of everybody, going to the Sun Belt, going to Texas, Florida, Tennessee, for crying out loud. I mean, is it? I don't even know where they're putting those people, but are those markets appreciably stronger? Are we seeing more activity there than maybe other parts of the country?
That's right. In the latest S&P Case-Shiller report, the markets that experienced the strongest growth were in the Rust Belt, and then you also had New York. So it was really the Midwest, the Northeast that are outperforming, and then the West Coast, traditionally more expensive markets that really have experienced the strongest price declines. So you've got your San Jose, San Francisco, have had a tougher go in a rising mortgage rate environment.
So I imagine workers there are still in strong demand, construction workers. Are builders able to get everything they need, land, permits, labor?
It's still tough. The supply chain headwinds, the supply side headwinds for builders, some have eased. Some of the material supply side challenges have eased, but there is still a chronic shortage of skilled construction workers. And so, the construction industry is still contending with some of these headwinds.
So do you guys at your shop, do you have a view on mortgage rates, kind of where you think they're going to be 6 months from now, 12 months from now?
Mortgage rates are notoriously difficult to forecast because they're tied to, the 10-year Treasury, which can be influenced by everything from, geopolitical tensions to recession to, of course, inflation. But I will say that the Fed has maintained its hawkish stance. They've made it very clear that they intend to keep rates higher for longer, and that means continued upward pressure on mortgage rates. I'm certainly not seeing mortgage rates, getting back to, I think one of you said you have a 3% mortgage. I'm not seeing that happen anytime soon.
Thank goodness. That was me. So if you have, I guess, slower household formation because affordability is off the charts, does that also mean consumers are spending less money, at, I don't know where people go these days, restoration hardware, Crate and Barrel, furnishing places, putting things together?
I mean, there is a multiplier effect on the economy, certainly from demand sort of subsiding for housing, and of course, if construction slows further, that will have a multiplier effect on, durable goods, housing services. So certainly reduced demand for housing due to the affordability environment can impact demand for furnishings and all of those.
All right, Odeta, thanks so much for joining us. Odeta Kushi, a Deputy Chief Economist for First American.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
GLCO Go, the global commodity prices. That's the function for that. I look at the metals here. Year to date, pretty much everything is down on a year-to-date basis. A couple exceptions, most notable being gold, that's up 3%. Let's see what's happening in the world of metals right now. When we talk commodities, we talk crypto. We talk to Everett Millman. He's the Chief Markets Analyst at Gainsville Coins. So, Everett, what is happening with gold here? What's the call? It seems to be bucking the trend where I've got aluminum down, copper down, gold down on silver down on a year-to-date basis, but I've got gold higher.
Yeah, thanks for having me on. I think it's really interesting that gold has been fairly resilient, hanging out around that 1900 mark, even with so many headwinds working against it. You have the dollar climbing to its highest in 6 months. Rates being higher, real rates being higher is usually negative for gold. And we've also just come out of the summer months, which are typically, they see poor seasonality for the gold market. And in spite of all that, you're right, gold has held up relatively well. And I think a lot of it has to do with the fact that central banks continue to purchase gold and kind of place a floor beneath the price. And in many cases, sure, this is done to stave off currency depreciation, but it's also a sign that central banks are probably hedging against the potential for a policy error or an economic downturn in the near future.
So which central banks had the most gold and who's doing the buying?
So as of now, the Federal Reserve still holds the most gold in the world, but the big buyers we see are mostly in the East, especially as we've seen outflows from gold ETFs in North America and Europe. Typically, most of that gold ends up flowing into China and India. And so the People's Bank of China is certainly continuing to buy gold. And what's interesting is there's been this persistent premium on gold in Shanghai relative to London. Now, there is some speculation that that's perhaps due to policies followed by the PBOC, but really what it says to me is it's just a sign of robust demand for gold in China. And that's important because China is always the number one consumer of gold in the world.
By the way, how do you play that arbitrage? I mean, it's not like you're going to load up, a plane full of gold bars in Shanghai and fly them into Heathrow, right? Is there any way to play the difference?
Well, that's a great question. There's been some suggestions that perhaps that could be done through Hong Kong, given that it is still under Chinese rule, but is somewhat of a separate, special financial zone. I don't think that there's any practical way to play that arbitrage. But again, outside of the East, sentiment in the precious metals market is still rather pessimistic. So even if there was a way to play that, I don't think a lot of investors are really tuned into that or paying attention to that.
Everett, how closely do you watch the dollar? I mean, I always have the Bloomberg dollar index on my screen. A lot of people watch just DXY. But right now we're trading at 1270. It's the highest level we've seen in about a year. Showing some real strength against our trading partners, but also obviously strength in gold terms, strength in oil terms, etc.
Right. It's always important to watch the dollar. The fact that it has strengthened so much against its peer currencies around the world shows up in the gold price, especially this week. We've seen gold drifting lower. But when you look outside of the U.S., in most other currencies, gold is at or near all-time highs. So it sort of is just a relative comparison that the strength of the dollar in the West, it tends to dampen interest in gold. But there's not always a direct line. So about a year ago, we saw the last time that the DXY was at these levels, we saw that both the dollar and gold rallied in tandem. And sometimes when there are safe haven concerns, you can see that kind of paradoxical relationship happen.
Yeah, Paul and I were just talking about how boring it's been to quote Bitcoin lately. It's just holding at 26,000. But actually, when you look at the strength in the dollar, it's pretty interesting that Bitcoin's been able to hold this level.
That's right. It has been somewhat range bound. And I think clearly we're going to have to get some more clarity on the regulatory end. We still have not gotten a Bitcoin ETF approval. And to kind of make a comparison to gold, the gold market about a decade or two ago experienced much greater liquidity and much greater demand once a gold ETF was launched. So I believe a lot of Bitcoiners are looking at that experience and hoping if there is a Bitcoin ETF, it's going to ease access for kind of lowering that barrier of entry for people to get invested into Bitcoin. And it's also important to keep in mind that anyone who has been in the crypto market for a few years, they've experienced these kind of crypto winters before. So the current poor sentiment regarding cryptos and Bitcoin is not necessarily the death warrant that I think some perceive it to be.
So what is the future of this ETF here? I mean, it feels like the crypto space, Matt and I were just talking about it, it's no longer top of mind or it's on what everybody wants to talk about as much as it was, say, 6, 9, 12 months ago. And I'm wondering, is the space just waiting on how this ETF issue will be resolved?
I think so. And along the same lines, you have this tug of war between the greater trust and legitimacy that would come with an ETF and greater regulation. But on the other hand, pulling in the opposite direction is the fact that the crypto market has always been characterized by this kind of freewheeling behavior where it thrives without any oversight. And I think one of the important things that, as you point out, that the market seems to be waiting for is there's an IRS proposal for new tax reporting rules on digital assets. And so far, that has not been very well received by the crypto industry. And we already know with the FTX debacle what a complete lack of regulation and oversight looks like. But we're going to have to get some kind of clarity in that realm. Otherwise, you will see all of the activity in DeFi, in Web3, in the crypto space will almost certainly move offshore and leave the US.
All right. So Run, quick question, 30 seconds. Silver, what's the call here?
Silver is one of those interesting, disappointing things for the precious metal bulls. It has not really performed the way that they expected. At the same time, we have to keep in mind that year on year, silver's up about 23%. And I'm looking at a lot of supply concerns. Mexico has seen its silver output drop by nearly 20%. They're the world's largest producer. So supply concerns, I think, give silver some fuel to move higher in the short run.
All right, Everett, thank you so much. We appreciate that as always. Everett Millman joining us, Chief Markets Analyst at Gainsville Coins.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, we here in Bloomberg Radio and TV, the media side of Bloomberg, we're here every day. We're required to be here every day. And there are a lot of people in Bloomberg Radio and TV that did not miss one day during the pandemic. They came in every day to get the shows on the air. But we are clearly the exception, not the rule. It seems like this hybrid work is here to stay. Let's see where the latest findings are. Eileen Mullaney joins us. She's a workforce transformation lead at Vialto Partners. She joins us via Zoom. So Eileen, is, I guess, hybrid work, is that the new normal going forward?
That is the new normal. And first, thank you so much for having me. Yes, that is the new normal. I think what we're seeing in a lot of industry sectors, though, is this combination of really hybrid work. There really is a big focus on return to the office. So we definitely are seeing that. I think in the height of the pandemic, we never thought we'd see return to office. We thought we were fully remote forever, but there has been a big push to get people back to the office. And I think 3-2 or 4-1 is the most common schedules we're seeing.
I mean, there are a lot of folks, it seems like a lot of industries, a lot of companies. I'm thinking the financial services industry. I'm thinking the Jamie Dimons of the world that are pushing still for 5 days a week. But they feel like the exception rather than the rule here.
I think we're not seeing as much on the 5 days a week, though. I think there is a lot to be said for human interaction, collaboration, more than you can do just on Zoom. So I do see a lot of focus on that, especially when it's very junior staff, young staff that perhaps have not developed their professional network. And that really is a plus to be in the office and just see how things get done. Also, some of the challenges with developing relationships with new clients, new customers can often be difficult if the relationship is purely video-based and not really in person. So I think for me personally, the hybrid is kind of the best of all worlds. But I do think there are some CEOs, some companies in particular that are really trying for that 5-day-a-week work in the office. But we have seen employee expectations have significantly changed coming out of COVID.
Yeah, I have two 27-year-olds and a 25-year-old in the workforce, my offspring. And to them, coming in 5 days a week, it's not even something that's in their mindset. And I kind of feel like this generation, it's just a non-starter. Is that kind of how it seems at this point?
I think it certainly feels like that sometimes. I think that a lot of them started their career in COVID, so it's all they know.
Yep.
But I think, and some of them do have an expectation when they do come into the office, kind of what's happening that day. Is there something exciting? Is there, a happy hour? Is there a lunch? What's happening? Why do I need to be in the office? And I think it's because they haven't seen the benefits of that kind of collaboration full time. So I think that's the important message to get to all of them for sure.
When this whole thing started, I just saw no way that this economy could function efficiently with everybody working from home. Like I thought, when, for example, just in the business that I'm in, Wall Street, I couldn't imagine traders trading as efficiently and as successfully from home as they do in the office. And they've got all this computer screens and all the technical tools, but they did. And the economy did. And the global economy did just well. I mean, it's just really shocking how it really played out.
I was one of those that thought, this will be in place for about 2 weeks and we'll get back to normal. I kind of shared the same opinion that it was going to be hard to really shift to being productive, efficient, and just continue on as if this was a normal. And none of us were really prepared for it, and none of us were really trained properly for it. It's different with organizations now. They're doing a lot of focused training on helping managers understand how to really manage a workforce that's not in the office, how to kind of look at social cues on video, all different kinds of training that we had never thought of putting our teams through before COVID. So certainly a lot more aids and tools to help people. But I agree with you. I don't think we all expected it would be quite so successful without any planning or training for sure.
I think one of the unintended consequences, but something that people are starting to think about now is this kind of creating a divide or exacerbating a divide between those people, we'll call them essential workers that have to be in, whether it's on a factory floor or in a fast food restaurant, and those that don't, and those that actually have the flexibility. How big of a problem is that now, and could it evolve into?
It continues to be a problem. We certainly saw it as a lot of organizations started to design their future of work programs. And this was during the height of COVID when, as you said, those essential workers had to be at work 5 days a week and everybody else was at home. And I think companies still really struggle with what kind of peer equity do we want to develop? What kind of culture do we want to develop for the organization when there's definitely in a lot of industry sectors, a lot of companies, very distinct workforces, a part of the same organization. And it's very challenging to come up with policies that are viewed as equitable across the board for everyone when certain roles and even certain locations just have a bit more flexibility than others. So I think that tension is here to stay for sure.
And I wonder if that's kind of driving to some extent some of the strikes that we've seen, worker strikes, whether it's the UAW or the actors and writers in Hollywood or the UPS drivers. I'm guessing a lot of those folks are saying, I need to get some now. I mean, I was an essential worker. I made the big commitment. I took the risk. Now I won something.
It's hard for me to comment on those. I'm not part of any of those unions, but I can say for the organizations that I work with across the board, flexibility is a critical design feature more than it ever was before. And it's interesting when companies think about flexibility for their workforce, they think about it in two parts. One, employee flexibility, where the employees can work flexibly. And that doesn't always mean I get to work at home, but it could be more creativity around the shifts they have to work or how much time off there is. So I think that whole kind of creative approach, it's not kind of business as usual when we're thinking about designing policies and approaches. And then on the other hand, there's also flexibility for the managers to be able to have a little bit more autonomy in the decisions they can make and the arrangements they can approve for their team members.
Right. It's a whole new world. Everybody's adapting, it seems like. Eileen Mullaney, Workforce Transformation Lead at Vialto Partners, talking about the new workforce. It appears to be for most organizations some form of hybrid. And I guess a lot of folks are still trying to work that out. But whether it's 3-2 or 4-1 or something different, hybrid seems to be the new normal.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.